Did you know that fixed income futures can play a big role in how views are expressed on the economy, interest rates, and monetary policy? In this video, I'll be speaking about Treasury spreads, a foundational concept in the interest rate futures market. We'll walk through what Treasury spreads are, why they matter, and how traders use them. Stick around if you're ready to dive deeper into the world of fixed income markets. Let's start by defining what Treasury spreads are. At its core, a Treasury spread is the difference in yield or price between two U.S. Treasury securities with differing maturities. When you listen to the news and they talk about the yield curve, this is what they're talking about. Historically, this is seen as a critical barometer of economic sentiment. The most commonly traded example is the NOB Spread, which stands for Notes over Bonds, and refers to the yield spread between the 10-year Treasury note and the 30-year Treasury bond. Spreads can be constructed using Treasury securities in the cash market or through futures. A typical NOB trade is a 2-to-1 ratio with 2 Treasury notes for every 1 30-year bond. Futures traders commonly use price differences between these contracts to track and trade yield curve movements. Why are Treasury spreads important? Treasury spreads are more than just numbers. They can be seen as a signal of market expectations. A steepening yield curve, where longer-term yields rise faster than shorter-term ones, can suggest optimism about future growth and inflation. A falling or inverted yield curve, where shorter-term yields exceed longer-term ones, is often viewed as a warning sign of economic slowdown or recession. By trading Treasury spreads, you're not just speculating on the direction of interest rates, you're trading the relationship between different parts of the curve. So how do traders use Treasury spreads? Traders often use spread trading strategies to reduce exposure to broader market moves and instead focus on the relative values between two maturities. For the NOB spread, a steepening trade would involve buying the 10-year note and selling the 30-year bond, with the expectation that the long end of the curve will rise faster than the belly. Conversely, a flattening trade would involve selling the ZN and buying the ZB with the goal of generating a narrowing spread. These trades are typically adjusted using DV1 weighting, which equates the dollar value of a basis point move in each leg, helping traders stay focused on the curve's shape. To wrap things up, who are the typical participants in the Treasury spreads? Treasury spreads may be widely used by macro traders, hedge funds, asset managers, and even central banks as their tools for expressing views on Fed policy, inflation expectations, and global risk sentiment, all without taking an outright directional position on interest rates. What drives changes in Treasury spreads? There are a range of influences, including Federal Reserve policy and interest rate projections, inflation expectations, economic data like GDP, CPI, and employment reports, global demand for U.S. Treasuries, and even geopolitical developments that shift the demand for safe haven assets. All of these factors can cause shifts in the curve and therefore the spread between Treasury maturities. Thank you for watching today's EdgeShort on Treasury spreads. If you're interested in learning more about the yield curve strategies or how to trade them using CME Treasury futures, reach out to me in the link in this description. See you soon.